Are you an emerging fintech with a
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Happy Friday. We're back for another live episode of the Tech Behind FinTech. Pretty exciting show today. I'm joined with my guest, Nick Halaris. Nick, welcome to the show.
Yeah, thanks for having me on again. It's good to see you.
Yeah, you're like a friend of the show. So we're friends of the show. We bring them back on when things with their expertise matches what's going on in the market, and we want to kind of discuss it and break it down. Today's topic, really near and dear. We all hear about corporate real estate, commercial real estate. Today's topic, corporate real estate collapse, separating fact from fiction. So our goal is really to get to the bottom of it. Nick has a lot of experience in this area, and I would like to, before I get into Nick's bio, let me just do some housekeeping things real quick. Give me a second, hide that. We are streaming live from Facebook, LinkedIn, YouTube, Twitch. If you want to make a comment, please do so. We love comments, love engaging. I'll put it, you'll be part of the show. We also have a live stream going on from Instagram. To all my Instagram folks, if you want to be part of the show, you can go to the Tech Behind FinTech. If not, just leave a comment there and we'll get to your questions or your comments. Without further ado, let me introduce my guest. Nick Halaris is the founder and president of Metros Capital, a company dedicated to investing in and developing transformative real estate projects. Nick believes strongly in the power of the built environment to shape lives and is dedicated to improving lifestyles in America's great cities through a commitment to innovation, quality, and design and sustainability. Metros Capital invests in the urban core of America's great cities and currently has projects in Los Angeles, Atlanta, and Nashville. Prior to founding Metros, he was a co-founder of and the president of AH Capital, where he invested more than $150 million in residential and multifamily assets, buying, rehabilitating, and selling over 150 residential properties throughout Los Angeles County and over 2,400 multifamily units throughout the Southeast. Nick is also the author and publisher of Profit, a widely read monthly financial newsletter, and a frequent contributor, host, and moderator for many of the top financial news platforms in the world, including Real Vision and Blockworks. Nick holds a Bachelor of Arts with high honors from the University of Michigan and a Juris Doctor from Stanford Law School. In addition, Nick, you started a new podcast. Shout out the name of that podcast.
Yeah, it's really easy. It's called the Nick Halaris Show, and it's a show that's designed to sort of inspire and help people understand how to become more impactful citizens and explore the relationship between citizenship, service, and success. So we cover a lot of topics, but the goal is to help people have more meaningful lives.
That's awesome. That's awesome. Nick and I offline always talk about like working out and fitness and training, fighting in terms of jiu-jitsu or Muay Thai. So I always enjoy our offline conversations. Today's topic, the corporate real estate collapse. I mean, listen, we all see what's going on. I want to understand it. On the news, you hear a lot of different things, right? Since the pandemic, obviously, people working from home, saying that caused a lot of the commercial real estate issues that we have right now. I have a stat. They say it's from McKinsey's report. Only 37% of workers have returned to the office every day since the start of the pandemic, and commercial real estate values are getting pummeled because of it. What are your thoughts on that, Nick?
Yeah, it's an interesting stat. It's partially true. We're in a weird moment in time. I actually just finished an article for my newsletter, and the title of it is called like The Perfect Storm with a question mark. because we're living in a time where there's this crazy dynamic where on paper, and maybe even in some sense in reality, this is the perfect storm for real estate. And you would expect, given the confluence of factors that are sort of in play today, that real estate across the board would be getting crushed. But the reason I put a question mark on there is that's not necessarily true. So why is it a perfect storm? There's essentially three reasons why, in my view. Number one is the Fed basically introduced what I'm calling the great interest rate shock of 2022 into the system by raising interest rates by something like 500%. They were at quarter point and now they're at 5.5. And the reason why this is problematic for real estate is that these assets had gotten, real estate assets around the world had gotten bid up so much in the preceding decade, and especially during the blow off top phase during the COVID years, that almost the entire stock of commercial real estate was trading at less than a 5% return going into this interest rate shock. And so fundamentally what's happening to real estate owners is that they're facing, depending on their capital structure, they're facing like the fundamental problem of the logic of arithmetic going against them. Their borrowing costs have gone up way more than they can stomach, than these assets that they purchase can stomach. So that's problem number one. Problem number two is you have a banking crisis. So look, the last time you had a banking crisis in America, commercial real estate prices fell like 40%. It was nuclear winter out there. You couldn't transact. We had one already. So that's element two of the storm. Element three is the fact that the potential for sticky inflation appears to be a possibility. And so not only are interest rates high, not only is the banking sector sort of in crisis, but it looks like these higher rates of interest are here to stay. And that's problematic for real estate.
You say sticky inflation. What do you mean by that?
Yeah, essentially, look, the Fed has a 2% target. They're getting close. They're in the threes or something like that. I think the CPI came out this week at like 3.7. But they claim, just recently at Jackson Hole, they reaffirmed their commitment to this 2% target. And so what that means, or what that's signaling to the market, is like they're going to go all the way. They're going to keep rates high. They may even raise rates even more. And if we get any movement in the other direction, like for example, from oil prices or from rental inflation, that could be a challenge for the Fed. So the Fed is kind of painting themselves in this corner like, hey, we got to get to 2%. They've taken it down from whatever it was, 9 to the 3s. But if they want to go all the way, they're going to have to keep raising rates. Meanwhile, there's a risk out there just from the way the CPI is calculated that the CPI could actually go in the other direction. All it would take is small movements in energy prices, for example, or multifamily rents or shelter CPI. Those are the two biggest components of CPI. And so you get
CPI, Consumer Price Index. Am I correct?
Yeah.
Or okay. So for people that don't understand that or never heard that term, can you break down what CPI is?
Yeah, basically it's an economic indicator that the government, I forget which entity actually puts it together, but they attempt to track the price level in the economy and the rate of change in the price level in the economy. And it's a basket of goods. Like they come up with this hypothetical basket of goods that the average American family would purchase, and then they keep track of all these various prices.
I think last I saw, like milk is one of them.
Yeah, there's like probably hundreds. It's been a long time, but what people need to understand is the big components of it are energy and housing. And so right now, that's what people should pay attention to, because if those go in the other direction, they have been coming down. Energy came down quite a bit after the shock from the war in Ukraine, and even rents have been coming down. But if they go in the other direction, that's where you're going to get this sort of phenomenon of sticky inflation, and the Fed is going to be forced to choose between keeping rates high and beating inflation and probably causing like a pretty nasty recession.
All right, so you dropped a lot, right? So from outside looking in, you have, I want to get back to the stat, which is 37% of workers, because from the news articles and, major corporate CEOs urging workers to come back to the office, one will get the idea that, oh, this whole work from home environment is the thing that's causing the corporate real estate to collapse. But because of the perfect storm that you mentioned, there's a lot of other factors. And that's the fact from fiction myth I want to really talk about before we move on, and just really get your thoughts on that. Because, the news is that's what we're hearing. Oh, people are not working in the office, so it's empty, and corporate real estate is suffering, and this is the collapse. And high level, that's what people hear. You're right. So you have to return to the office, but there's other factors. Can you touch on that?
Yeah. Why don't we pull up some of these charts, because I think it will actually be helpful for people to have a visual as we talk this through.
Cool. Which one do you want me to pull up?
Let's pull up go back to sort of the beginning. No, you can go back to the beginning, actually.
This is the first one I have.
Oh, is it really? Okay. Move down a little bit. I'll tell you when to stop.
No problem.
Okay. I guess a couple of them maybe didn't get in.
Oh, maybe. Okay. That'll be my fault.
Okay, no problem. Anyways, the chart I wanted to go back to that office one, because I'll talk that through after I give the answer to that one. You can go to
this one on here.
No, the office. Yeah. So look, the office thing, let's put that aside for 1 second. There was another chart that I wanted to start with, actually, which is essentially like an index. It's called like the Green Street Commercial Property Index. And it shows the sort of an aggregate price level for commercial real estate valuations. And what's interesting about it is, I think the chart I had, it went back like 10 years or 15 years. So it showed the great financial crisis. And what happened last time around was that commercial real estate values got crushed by something like 45%. And what's interesting about the chart that shows that the current period is that it's not really that bad out there. It's down like 10% or something. So in aggregate, even though it's like this perfect storm out there, there hasn't been that much damage. Office is the one anomaly. Office is in a total tsunami. It's a worst case scenario for the office market. And this chart right here shows, and the statistic that you just quoted basically illustrates why. Like, office buildings at 50% occupancy, they don't pencil. They don't pencil even when interest rates are zero, and they certainly don't pencil when interest rates are 500 basis points higher than that. And so what we're seeing right now across the country is that office assets are getting foreclosed on. They're being sold for significant discounts to replacement value. And there's kind of like a doom loop, especially in the big cities, because many of the sort of cities around the country rely on the office ecosystem to support their economy. The big drivers of property tax, big drivers of sales tax. And so it's like a nasty cycle happening in places like San Francisco, for example.
All right, yeah. So that's a good point you mentioned. I mean, I remember when I was going into one office, and there was this guy, right, small business. He had this fruit stand, but the thing about his fruit stand was he had the blending machines where he could make you this awesome shake, right? So talk to him one day. I'm a fan of small businesses. So him and his wife, right? They wake up every day. They get to that location 5, 6 in the morning to secure the spot. This was in Midtown New York. They sell their fruit all like throughout the day. They leave, come back the next day, do it again, do it again, do it again, do it again. Now COVID hits, right? This is just like we're talking like this is like real. He's an example of a bigger issue. COVID hits. I have no clue what happened to this guy. I know that the people in the office, right, are no longer coming into the office, right? So we're not buying his product. He's obviously impacted. Everybody gets the alert. We can go back outside. As the stat just says, only 37% of the workers go. Is he still there? I don't know. I haven't been around. and I'm sure there's thousands of businesses like this. How does that cycle impact, right? So he has to obviously reinvent himself, or he has to figure that out. But what you just said, right? It's like it's other businesses that get impacted in this whole macro economy of workers going into the office and supporting the ecosystem. What are your thoughts?
Yeah, that's the tragedy of the office story. Like, I was thinking about this the other day when I was writing the article. Like, there's going to be a humongous amount of pain in the investment world from the office meltdown. And look, our system can't really afford massive capital losses because of all of our obligations to our pension holders and whatnot. So it's not like it's a victimless situation, but by and large, the people who own offices are financially capable of bearing that loss. We're talking about like pension funds and endowments and stuff. And so, yeah, their returns are going to be hurt, but the investment side of this is something that we're going to get through, even though it's going to be nasty. There's going to be a huge mark-to-market loss on office around the country. But the real tragedy is in all these businesses and in the government budget crises that are probably going to emerge as a result of this. Because like your fruit stand example, like, man, that you just write that large across the whole country. It's thousands upon thousands of small businesses, jobs, and they're gone, and they don't look like they're coming back. Like Asia, like if you look at this chart, like Asia and Europe has done a much better job of getting people back in the office. It doesn't look like it's happening in the US. Now, maybe there's a chance, like maybe this is too doom and gloom. Maybe there's a chance that these corporations are successful in getting all of their employees back into the office. I think it's unlikely. I think the work from home thing is it makes too much sense. But that is one of the possibilities. Like if you were a contrarian investor right now, that's a decent idea to consider. Like, hey, maybe if they're selling a downtown office at 10% of replacement cost, maybe I should just buy it and see what happens. But it's a long-term game if you take that approach.
You mentioned San Francisco, cities like New York. So you have a huge supply of empty offices. You have a huge demand of actual places to live, like apartments. Like people need places to live. I think it was some interesting number, like 500,000 new apartments in New York that's needed because of the migrant issue and different things happening like this. There are projects underway that convert office space into apartments. What are your thoughts?
Yeah, I think it's something that's been talked a lot about in the media, and it's a strategy that's definitely worth pursuing. Like I have some friends here in Los Angeles who've actually been doing it for like a decade, and they've turned some Koreatown buildings into some nice living spaces. But it's actually rather challenging, and the truth is that it's not going to be the panacea that people may hope it's going to be. So many of these offices are either in garbage locations. Like imagine like a suburban office complex in like Texas. Like no one's going to live in an apartment in that location. So there's that problem. In the cities, the problem is more of an architectural and a cost and a regulation problem. So even though a place like New York has a bunch of empty office space, like to get those buildings to pencil as a multifamily conversion or even be allowed by the government is like such a big challenge that I don't actually think we're going to see that much. I think there'll be some, but it will not be enough to save the office market from real damage.
A stat, because you talked about New York and San Francisco. New York City commercial rent prices were down 22% from 2019, and San Francisco rent prices were down 30%. Interesting stuff. So just wanted to throw, I know we mentioned New York, so I wanted to throw that stat out. So so based on what you're saying, right? We have commercial real estate on a whole, but then we have like corporate office space. Everything we're talking about now. So are we saying the work from home aspect definitely impacted the office space? or is there other factors in terms of the perfect storm that cause some impact to that sector?
Yeah. Let me try to answer it this way. I think that office is in many ways an anomaly. So the perfect storm is out there, and the perfect storm, in theory and on paper, should be impacting every asset class. But the only asset class really where we've seen like real damage, like distress type damage, is office. And the reason is that office has this unique situation related to work from home where not only are they facing this higher borrowing costs and all that stuff, but their revenue is going down at the same time. And so office is already getting crushed. The other segments of the market are actually holding up reasonably well. And there's several reasons for that. One is that even with disinflation and even with the rapid increase in the interest rates by the Fed, the economy is actually doing pretty good. So multifamily, for example, which had a blow off top in 2022, just like crypto, like multifamily valuations went crazy in 2022. They're not down that much either. They're maybe down, depending on the market, let's call it 10 to 20%. And the reason is that the job market is still strong. So this sort of Goldilocks economy that we have is keeping multifamily actually relatively stable at this moment. There are some players who are struggling because they're upside down in their loans and stuff like that. But the fundamentals of that industry are actually okay. And they're okay because people still have jobs. And so they're making their rent payments.
Just when you say multifamily, are you talking about under 4 units, which is considered residential? Or are you saying multifamily, like apartment complexes with 10, 50 units? What are you exactly referring to?
I think anything that's rented, essentially.
Okay.
That's true for even single family houses, in my view. Like those assets have held up specifically because there haven't been job losses.
So bringing up single family, this is something, and I mentioned it in other episodes here and there, but I've been a real estate investor since for a long time, like we're talking decades now. Also, have a real estate license. So in terms of residential, I definitely I'm confident in that aspect of turning stuff around and getting it rented. I'm into long-term holds. So you mentioned single families. I see a lot of private equity firms scooping up single families in the truckloads. Like it was a big thing, right? And it was like, whether it's what are your thoughts there? Like what's going on in that?
Yeah, I think that if you want to go back to the chart pack, actually, there's a chart somewhere towards the end of the home builders. Right there. You just passed it.
Right, cool. This one? Or
no, the one right before it, that one.
Cool.
Okay, so this is a chart of home builder stocks from June of 2022 to the present. And look, they're up like 35% or something.
Oh, wow.
And
when we talk about home builders, we're talking about like the D.R. Hortons of the world.
Yeah. Lennar, big publicly traded home builders.
Okay.
And what's crazy is if you rewind the clock to June of 2022 and asked almost any investor on planet Earth, like, hey, what would you think about home builders if I told you that mortgage rates were 7.5% and home sales were down 50%? What do you think home builder stocks would do? They would all be like, oh man, they'd be down 50%, but instead they're up 35%. And it's a function. And you have just recently, Warren Buffett invested $800 million in 3 of the members of this index. So you have the exact opposite. Basically, you have a crazy bull run. You have bullish sentiment even after this 35% increase from one of the best investors in the world. And there's a story there. And what it points to, in my view, is that American single-family housing, whether it's for sale or for rent, is probably the best risk-adjusted investment in the world in real estate. And it is for several reasons. On the demand side, if you're an international investor, it is in a safe place. And with laws that you can respect, and it produces a rate of return that even today probably still beats inflation. On the supply side is an absolute disaster of a legal and regulatory overlay that guarantees that house prices in this country are going to continue to go up. So all across the country, the development process has been captured by zoning politics, anti-development zoning politics, outright corruption, overregulation. Like, it's literally like the perfect soup to guarantee that house prices continue to go higher and affordability continues to be a problem for American households. And so you put those two together, you get you get the demand side of it. Like, there's capital coming into this. People want to buy homes as a result of COVID. You couple it with this supply disaster, and it's the perfect storm in the opposite direction.
You dropped a huge, let me get rid of this so I could just talk to you real quick. So you dropped something huge there. The corruption aspect, the zoning, that will make or continue to make home prices go up. Can you elaborate on that, please?
Yeah. Basically, what's emerged in this country over a long period of time, this didn't just happen in the last decade. This is probably like 50 years in the making. But there's a dynamic where in the big cities in particular, the anti-development, the not in my backyard forces have completely captured the power structure. And there are all kinds of reasons for it, but the way that it manifests for ordinary families and renters is that there's not enough housing coming online. So it's essentially like a market failure in an already slow moving, like building stuff already takes time, but you introduce this sort of political capture of anti-development forces and it makes it significantly worse. And this has been going on for so long all across the country that it's now like an insurmountable, like California, for example, used to be a robust housing market. Like, there was a period of time when all the people were coming to to California after the war and trying to relocate here, where they're building these massive suburbs, which you can, when you fly into LA, you see what that looks like. It's just houses everywhere, single family houses everywhere. But now California has been so bad about development that the people who do the estimates, like McKinsey, I think McKinsey actually did an estimate in 2016, and their number was like 6 million units short in California.
6 million.
6 million. That's if you want. I think the way they did the study, I forget their methodology, but it was something like, if you wanted it to be affordable, that's how many you'd have to put on. So maybe you don't really actually need 6 million, but if you wanted the price to adjust to where it wasn't eating up such a high percentage of household income, you'd have to have 6 million units. And the truth about California, like, I don't have the numbers right in front of me, but man, on a good year, like, they're building like 100,000 units or something. So it's impossible. It's basically, they're never going to build. It doesn't matter what they did, what kind of laws they passed, what kind of money they threw at it. They've dug themselves in such a huge hole that it's never going to happen. And now that's happening in other places, like these red/purplish states that all the people started moving to during COVID. They're becoming just as anti-development as the big cities, as the New Yorks and San Franciscos and LAs of the world. And they're seeing the same thing. It's homeowners banding together. Most of them, not most of them, but in many cases, liberal homeowners who on paper support things like affordable housing, they band together and they stop development in their towns because they're afraid of density or whatever. I'm not sure what they're afraid of, but that's what they're doing.
Very interesting thought process on that. I mean, we know that, that's everyone was talking about that, right? It's housing shortage. Housing is very expensive. Interest rates are higher, mortgage prices are higher. I think one of the strategies from the home builders, where they a lot of them now are controlling their own mortgages, so they're able to offer certain discounts. So that's why they're getting their sales up. But overall, this is a big thing we hear. Like, people cannot afford to buy, even if they wanted to. So that's an interesting point that you brought up. Let me jump into, there was another stat that I want to kind of go into. about 1.2 trillion of debt on U.S. commercial real estate is potentially troubled because it's highly leveraged and the property values are falling, according to advisory and service company Newark Group. What are your thoughts on that?
Yeah, let's pull up there in the middle of that chart pack that I sent you. There's a table that I put together. It's like a little Excel table.
Oh, I think I remember that one.
Yeah, let's see. I think you
This one.
just pass it. Yeah. So I put this together because I think it illustrates the problem that statistic that you just referenced perfectly. So this chart is essentially imagines a $10 million property that some investor bought at a 5 cap and financed with a floating rate loan at 4%. So imagine a multifamily deal purchased in 2022 by an opportunistic investor, and they bought it at this 5 cap and a 4% loan. So if you turn your attention, like I think the important column to look at is the cash flow, and where it says 4%, that basically shows what the cash flow of this building would be at various LTVs. So at every LTV on here, that building is looking good when the loan is at 4%. But when the loan goes to 9, so we get a 500 basis point increase like we had in 2022, that thing gets upside down real quick. And so even low leveraged situations are now underwater. And so you could have bought a deal in 2022 at roughly these kinds of terms. And if you had floating rate debt, which a large percentage of that bank debt number that you just quoted is floating rate, you're underwater and you're having to feed your property to make your debt payments. And so that's the mathematics or the arithmetic behind this worry on the 1.2 trillion is that a huge chunk of it looks like that. Now, multifamily is okay if you have the ability to sort of recapitalize your deal, put more money into it to fill these holes. Office, like we talked about earlier in this conversation, office is bad because the income disappeared at the same time. So not only did your borrowing costs go up, but your income just got wiped out as well. So the holes in office look even worse than this. But that's the arithmetic of it.
No, good point. For those, I know we take our video, this webcast, and we make it into a podcast. So I just want to be, for those who are not able to see this chart, right? It's basically going over what happens over time, like Nick just said, right? To just do a summary. Last year or 2 years ago, you were able to get this amazing interest rate at 4%. You bought it, and when you say cap, that's how much money you put down. Is that accurate, Nick?
No, the cap rate is essentially the unlevered income. So that $10 million property, if you bought it at a 5 cap, would produce for you $500,000 of cash flow.
Got you.
Before you put debt on it, yeah.
Okay, so you got this amazing property at a really good interest rate, but it was floating, it wasn't fixed. Fast forward, right, with interest rates going up, let's say you jumped all the way to 9%. Over time, you're now losing money on the deal in terms of your cash flow. So now you have to find other sources of revenue to put into to meet your debt obligation. So that's what we're reviewing.
Yeah, and it's not even over time. I mean, this happened overnight. I mean, the Fed raised 500 basis points in a matter of months. So buildings became underwater very fast because they're adjustable rate mortgages in many cases. So it took like 2 or 3 months, and all of a sudden you had a pretty healthy property turn into a very unhealthy property. And when you hear stories, like there's a lot of stories in the news these days about real estate syndicators getting in trouble, like that, even like Grant Cardone, who's like sort of a famous real estate guru, he's being sued. There's been a couple other companies being sued by their investors or getting huge chunks of their portfolio foreclosed on. The reason they're getting foreclosed on is that to keep these deals alive, if you were one of those multifamily syndicators, to keep these deals alive, you need to actually raise more money to put in the deal to pay for these holes, or you're gonna lose your ability to make your mortgage payments. And so that's what's happening right now. Like if there's stress in the multifamily sector, it's a result of these capital structures. And if rents, if we get a big recession, One of my worries about the future is that if you get a big recession in the US that results in a bunch of job losses and you get sticky inflation, like we talked about at the beginning of this program, you have a situation where interest rates are still high like this and the top line revenue is going down. So it's going to start to look and feel like the office market. And the office market in some cases is trading down, 50+%. And so something like that is brewing in multi if we get a big recession.
Wow. That is that sounds extremely scary from the investment side. Let me just get this off so I can talk to you straight. How do we solve this? Like, what's the solution? Or what are the series of steps to avoid that problem? Because as an investor, obviously not not obvious, but not in the office space side, more on the residential side. That is a scary prospect. I mean, you're definitely seeing, interest rates going up and the impact on your bottom line, right? You have to pay more, so you're making less and so forth. Your rents are not necessarily at times increasing at the same rate as the interest rates. You're literally, because you only could go up so much in your rent depending on the area, the type of product you have, and whatever. So you're making less essentially. Now, based on what you're saying, we have a situation where you're making less, maybe slightly upside down. Now that tenant loses their job. So now you have to evict. And during that process, you're not bringing in any revenue to support the loan. Now, eventually, you don't support a loan, what happens? You get foreclosed upon. Now, what are some of the things that should happen, or in terms of, in your mind, to reverse the situation that we're currently in, and the multi or single family investments don't end up like the office space?
Yeah, it's an interesting question. I feel like the Fed is essentially trying to land like some crazy gymnastics move in the economy where they can drive this COVID-related inflationary pulse out of the system without causing a massive recession. And I'm not sure there's anything the government can really do to prevent whatever is going to happen from happening. I feel like we shot this huge shot, like trillions of dollars of deficits. We took a big risk during COVID to try to stem what was ultimately going to be like a relatively short-term pain. And by doing that, we've exposed the economy to the potential for something way worse, because now the stakes are amped up. There's more debt in the system, and there's more people kind of exposed to the financial system than there was before. But ultimately, I think the answer to the question is look, it's basically out of our hands now. Who knows what's going to happen? The Fed is trying desperately to engineer a soft landing or a Goldilocks no landing where we don't even get a recession, and anything is possible. One thing we know about the financial markets and the economy is that it never really evolves the way you think it should. So on paper, here's what should happen on paper. We should get a massive recession. That's what should happen. Interest rate shock of this magnitude after a crazy speculative bubble in 2022. To me, all signs from the history would suggest that we get a big recession. But so far, we haven't seen that. We've seen some damage in some sectors, like crypto kind of got blown up. Venture got hurt for a while. Big tech got hurt for a while, but they came storming back this year as a result of sort of this AI phenomenon. So far, it's kind of hanging tight. But I feel like the balance of probabilities would suggest that this is probably going to go the other way. You got auto union as of last night, they're striking against the big three. You got Hollywood strikes. So you got all kinds of potential threats to this, notwithstanding the fact that inflation is still around, like we talked about earlier, and the Fed is determined to get it. So the Fed might actually raise rates into this uncertainty. And that is where I think they make their final mistake in this whole thing, and we start to see the recession. That being said, anything can happen. Who knows? We've learned that since 2020, since COVID, that you never know.
I want to take a moment to, we have our show is Tech Behind FinTech. We support emerging fintechs. I want to take a minute and talk about a featured company of the week, and then I want to get back to some questions, Nick. Let's do that right now. Our featured company of the week is Curacell. Curacell creates APIs that enable insurers to connect with digital distribution channels and to administer their claims cost effectively, thereby driving insurance penetration in emerging markets. At Curacell, they are building the rails to make insurance work for the next billion Africans and empowering businesses everywhere with the technology to embed insurance for their users. Why Curacell? Winner of the 2023 Viva Tech Africa Tech Awards FinTech category. Curacell is a user-centric and leverage on artificial intelligence technology to make insurance purchases and claims processing seamless. Their website is curacell.co. That's spelled CURACEL.co. That's the featured company of the week. So, everything that you're saying, right? One may say, should we still invest in real estate? I mean, Warren Buffett obviously just invested huge in a portfolio of stocks for home builders. But based on all the statistics we talked about and what you're saying, it's kind of doom, man. Like, should we still be bullish on investing in, even if it's residential property? Should we take a pause on it? Is it still a good investment? So that's what I want to understand. It's like one aspect is saying no, one aspect is saying yeah. I want to kind of understand your perspective on that.
Yeah, I think this is a very risky moment to invest for sure. I think there are some areas though where you could make intelligent decisions right now that are not crazy risky. So I'll give a couple examples. Like single family housing, I still think is a good story. Like Buffett's decision to invest in those home builders right now, I support it. I think that market has legs for a couple of reasons. One, this structural supply issue that we talked about, the fact that it's like impossible to build housing at any level of scale and speed in this country. And two, I do believe in the demand story for housing. Mortgage rates are problematic. So a 7.5% mortgage rate is very problematic for the housing market. But I think that people are so desiring of a home that they're getting to the point psychologically where they just are accepting the higher prices. And the home builders are coming in and also doing things like buying down their mortgages. So instead of paying 7.5, maybe they're paying 6 or something. So I feel like that story is still defensible and I like it. So single family housing, I'm still interested. Office, I actually sort of believe that for the right kind of investor, like for example, if I was in charge of like the CalPERS pension fund, I would buy these offices in the super core neighborhoods of California and New York. I would buy them. You have to buy them for cash, but I feel like even with work from home, which I think is a permanent feature of our system, the office ecosystems will return. We're already seeing it in other places around the world, like Asia and Europe. So even though it's going to be a while for that trade to play out, if you can buy a skyscraper, look, it's hard to build a house in LA. Imagine trying to like get the entitlements to build a skyscraper. So there's like this embedded value to those assets that I think a pension fund or somebody like that who had a very long time horizon could make a very good investments right now in that sector. And then multifamily is tricky because the threat of the job losses, like we talked about before, presents kind of a big risk factor. But I still think there are probably opportunities in places that are super supply constrained. So places that don't have a huge development pipeline, that if you had an opportunity to buy like a slightly distressed building or something, that's probably a good investment to make right now. And then other sectors which we haven't talked about, like industrial warehouse, manufacturing facility type properties, those are in a boom actually. And they're in a boom because of the continued strength of the US economy, but also the Inflation Reduction Act and the CHIPS Act, all this stuff that the early Biden administration passed, which incentivized with these huge government programs. Like, I forget the numbers, but it's like $400 or $500 billion of incentives to build manufacturing facilities in this country. And if you look at a chart, I should have included that chart, but there's a chart of manufacturing construction, and it's like it's going off the charts. And so those type segments are in a full on boom, which could be interesting. I don't know enough about it though to have like a super intelligent opinion.
That would make sense. I don't have the details, but I remember reading back, especially during COVID, right? The idea was, we have all the manufacturing places in China and so forth. Can we bring them over to the U.S.? So, I would then assume that's one of the reasons to give incentives to do that. So, and it's really interesting because in the conversation, I wasn't even thinking about industrial manufacturing as being problematic at all, because it's just like, that's one of the places you cannot do remote, right? You have to show up. The only remote aspect is some AI bot handling, a certain aspect of the process. But other than that, you have to be there. So, but no, really like your perspective on things. I mean, I asked for the show, but I also asked for personal reasons because I'm interested in that market. I do some things there, so I just wanted to kind of get your perspective. I too, here's the difference, and this is just what I've seen through experience. Right, have a multifamily. We get people that are on an apartment. Get 2 years out of them, great. Get a single family, you rent that out. I mean, they're gonna put their kids in a local school system. They're gonna put down roots. You're gonna get the time run from a tenant at a single family is just longer. It's more stable. Do you make as much? No, but the stability factor, the over time that asset increases value. So what I've seen through my experience, being from in the East Coast, and you talk to a lot of investors out here, they always say, "Oh, now multifamily is the key, multi this, multi that," and I drank the Kool-Aid for a little bit. But what I've seen though that just works really, really well, time tested, single family rentals. It just works. It's not as sexy, right? But it just works. It's like the turtle in the hair story, right? It's just over time it works. And you just get longer term tenants, and because it typically a family as opposed to an individual or a couple, right? But that's what I've seen, just through my experience.
Yeah, no, the single family rental it's a great strategy. Like a friend of mine, he does institutional real estate for large pension funds in Asia. So he carved out a niche for himself where he essentially puts together funds for Asian pension funds. And their number one asset that they're interested in is American single family rentals.
Get out of here.
It's the safest. I mean, people love to hate on America, and they doom talk about the decline of America. But for people with like a lot of money, like a pension fund in Korea or Singapore or wherever, the prospect of putting it into houses in America, like a suburb of America, looks really appealing. It's safe. Money's not going to be misappropriated from them or taken from them rather. And it produces a decent return, as you said.
Do people understand the magnitude when we talk about pension funds investments? Ballpark number of that fund. What are we talking about?
Yeah, in the case of my friend, I think it's like billions. I don't even remember how big it is. And it's been a while since I looked at the amount of money flowing into that space. But that space, like institutionally, is like just over a decade old, and it went from nothing to, I think it's quite sizable now on an annual basis, like above 25 billion a year or something like that going into single family rentals. But don't quote me on that because I haven't seen a chart in a while.
No, the reason I wanted to talk about that so people could understand the magnitude, right? This is not, oh, I'm just buying a couple of single family homes. This is like literally throwing a huge billions and billions of dollars into these units and racking up thousands and thousands and thousands of these homes for the portfolio for long-term purposes. So that's the reason why I asked. I just want to the audience who might not be as experienced with these types of funds and what does that even entail and the magnitude of it. I just wanted to throw that out there. Wow, just totally interesting stuff. We need to take one more break from our sponsors, and then we'll be right back.
Are you an emerging fintech with a limited budget seeking more sales and partners? Introducing Strategic Generation, your partner in leveraging cybersecurity for sales and partner enablement. Fintechs often lose opportunities due to unsophisticated cybersecurity programs. That's where we come in. Strategic Generation assists with due diligence, security posture visibility, penetration testing, and on-demand virtual CISO services. We connect your systems to our partnered platform, and voila! Instant access to real-time diagnostics and compliance frameworks such as SOC 2 and PCI DSS. Gain the confidence of prospects and partners. Strengthen your cybersecurity program and drive success. Stop losing deals due to cybersecurity. Visit strategicgeneration.com and click on Demand CISO to connect with an expert.
Yeah, man. Just really, really great conversation as always. Always leave these types of conversations with a lot of info and things that I want to now follow up on. So I always thank you, and I always love our time together. And especially what you do for your content and the information that you provide during on your newsletter, Profit, and so forth. It's interesting in terms of where do we go from here? I'm interested to see how things are going to play out, especially in the office space. Really interested to see how these things are going to play out. I like the content, what you said. If you were managing a pension fund, why not just buy it, right? And cash deals, you're not paying a ridiculous interest rate. This is the cash you have in reserves, and hold it for the long term, right? You're going to get it at a tremendous discount. It's interesting though you say that, but then the work from home aspect is here to stay. So like what happens? Like look at the WeWork example, right? It used to be a thriving business model, right? Now it's not, right? So this is interesting. Like I'm both the host and I feel like I'm also watching the show in real time. So I have a lot of thoughts going through my head simultaneously. Just what are your thoughts on that when we work in that business model, the different business models of that they used to rent out temporary office space?
Yeah, I think WeWork is actually kind of an anomaly. Like WeWork, what I mean by that is WeWork is going to fail no matter what. And the reason is that they put together the world's worst business plan. So if you take a step back and you consider what WeWork is a company that secured a bunch of long-term liabilities like office leases that are 10 to 20 years long. And they match those long-term liabilities with short-term revenue contracts with their quote members. And the reason that's terrible is that people could cancel their membership at any moment. So from a financial standpoint, WeWork is signing up for massive long-term liabilities and coupling those liabilities with revenue that could disappear in an instant. And guess what? When COVID hit, it disappeared in an instant. Everyone canceled their memberships. So that business was going to fail no matter what. The work from home phenomenon hurt them, made it worse for them, obviously, because the demand for office space is like so bad at this point that only kind of accelerated their demise. But I go back and forth on this work from home thing. I do think there are many instances where it's okay, but every time I do a lot of civic work in LA, and I meet with, a lot of the CEOs around town are in these groups with us, and every person to an individual, every single company is reporting the same thing. They want to be back full time in the office. And I was on a program the other day called 42 Macro, which is highly recommend. It's one of the best investment research services in the world. My friend Darius runs it. And we were talking about it, and he had an interesting theory on it, which is there's this phenomenon right now in the labor market because it's so tight called that he calls labor hoarding. And the idea is essentially like, look, unemployment's at 3 point something. There are 10 million unfilled job openings. So corporations have been incentivized to keep people working, maybe even when they had the justification for doing reductions, reduction in force type activities. So they keep people working. They're trying to keep their employees happy because it's so tight out there. And Darius's point was, well, maybe if you get a huge recession, it won't be as tight out there anymore. And corporations will be less inclined to give a crap about whether their employees want to work from home or not. And they'll say, look, you want the job? If there's 10 million, instead of 10 million job openings, if there's 10 million people unemployed, it'd be much easier for corporations to say, look, you're coming back to work. You want a job here? It's 5 days. So that's a scenario that could happen very easily.
Very interesting. I know there was somebody's getting a lot. It was a CEO recently said similar. I think he's in Australia regarding about I don't want to misquote it, but it was something to the same effect. Interesting. I mean, yeah, that's what I'm going to say to that. The last question I have for you is Airbnb. We're seeing now in a lot of cities they're putting more regulation around it, especially cities like New York and so forth. Which is going to, impact the host and so forth. They have to register. It's a lot more things, so it might not be as much host. And they're saying that can help with the housing crisis. What are your thoughts on that?
I'm glad you brought that up. I one of the charts I had, I don't know if I think it might be the last chart if you want to pull it up, basically showed the year to that one right there, the year-to-date performance of
I'm sorry, this one?
Yeah, that one. That's like year-to-date performance of Airbnb versus like some big hotel companies. And I was thinking about the reason I put this chart in here is because there is something really interesting happening in that space that may be a theme that you could make an investment on, which you pointed out, which is that the cities are absolutely coming for short-term rentals. And what's crazy about it is short-term rentals has become the sort of boogeyman for the housing affordability crisis in places. So even in places like the Southwest, where they have had quite a bit of construction over the years, like Phoenix and Scottsdale, places like that, the local politicians are blaming Airbnb for the emergence of housing affordability issues in those cities. And places like California and New York, like they're all too happy to do the same thing. Now, Airbnb and VRBO did not cause the housing affordability crisis in any place in America. That is an absolute BS narrative. However, politically, this is the easiest target in the world because it is true that if you take a unit out of supply to put it on Airbnb, that puts some kind of upward pressure on pricing for housing or even for rents in a market. And so the politicians have jumped on this narrative and they are going to regulate Airbnb out of existence maybe in some of these places. So I feel like that's a very challenging place to be. There's probably a case to make like, long, short, like just for fun. This is not investment advice, people, but a fun trade thought that I had is you could short Airbnb and go long these hotel companies. That might be an interesting, produce an interesting return. But the point to remember is the regulators are coming and their target is short-term rentals.
I mean, that's definitely what we see. I mean, and it's obviously going to impact Airbnb as a company, but also hosts that have been making a living. I mean, some people literally quit their jobs and are full-time Airbnb host for multiple projects, multiple leases. So that's going to obviously impact them. And it's interesting because that's one of the things I personally never, I don't knock it. I just like 1 year people. I like someone to get in and this, but I'm not, I'm a technology guy, but I just like, I don't want to think about it. I want you in, I don't want to think about it. And then until the next year. So, but, the short-term rental game and now what we're seeing happening, I find that very interesting. Nick, I obviously could talk to you for hours on hours, but I have to be respectful for your schedule and your time. I really thank you today for coming on the show, spending time with me, with us, with the audience, answering all these questions, breaking things down. Extremely informative. One of the shows that I'm going to probably have to revisit just to capture some things so I can do some of my own research. Any last thoughts you want to leave with, and then can you tell the audience how to find you and so forth?
Yeah. First of all, thank you very much, man. I just really appreciate the opportunity to come on here. I feel the same way. I always enjoy our conversations and look forward to talking about jiu-jitsu, offline. And people can find me. It's pretty easy. Just my name, nickhalaris.com. And you can subscribe to the Profit Plus newsletter there for free. Would love to have you as one of our readers. And you can also find the podcast, The Nick Halaris Show, on all of the major podcast places like Apple and Spotify and even YouTube. So just type Nick Halaris and you'll find us. And we'd love to have your support. Thank you.
Thank you very much, Nick. To all the guests, listen, we are every Friday, 12 p.m. EST. We're live. We have a series of interesting topics and guests in the upcoming weeks to the end of the year. So definitely tap in. And once again, look, I appreciate all of you. Thanks for all the comments, the questions, the DMs, the guest suggestions, just looking at the show, whether you're looking at it live, looking at it later, sending your feedback. Really, really appreciate the support. We've been at this for 3 years now. We are remaining consistent. So it's really exciting times for the show. You can catch us again next week, Friday, 12 p.m. EST. You can visit us at the Tech Behind FinTech to look at past episodes and so forth. To everyone tuning in from Facebook, LinkedIn, YouTube, Twitch, and all my guys on Instagram, which I see a lot of the guys on Instagram are people I train jiu-jitsu with. I thank you for tuning in. That concludes our episode for the day. Take care and have a wonderful weekend.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.